Welcome to Beyond the Huddle, guys. Today I will be talking to you about the stages of buy and sell models. Now, this is going to be a very integral part of your trading because if you have a certain template or idea of how the market should be moving or being created at specific levels that you have in mind, as we already spoke about in the previous videos, I showed you the locations of these liquidity models and where you should probably be taking entries. So when you add these buy and sell models, you'll be able to then confirm those ideas and take them to a deeper level. So what are the stages? As you can see here, you have the phase one, which is the accumulation, and we call it the left shoulder. Then we have the phase two, which is the head. That's the stop hunt or rate on liquidity. So as you can see already, this is what I've been having you guys focus on, that everything starts with the rate on liquidity, and then you start to make your decisions afterwards. So then after that, you're going to see your phase three, which is the right shoulder. This should be your retracement to a discount buy or a premium sell, and then you're going to wrap it all up with the phase four, which is your distribution, and that is also known as the expansion phase of the model. Okay, guys, so before we start talking about the models, I want to give a little bit of a brief explanation of where the models came from. So as you can see here, models of inspiration, we have the Wyckoff model, and I took these pictures just from Google search. And everyone's familiar with these, but the key of what I'm about to teach you guys here, or most people are familiar with this if you're into technical analysis, but what I'm going to teach you guys to focus on is how to confirm these specific phases of the models, okay? Because anyone can draw out, a swing high, a swing low, the phases, in hindsight and stuff like that. But knowing what triggers it real time, and also knowing what tools you're supposed to be using during what part of that phase is the important part, okay? During an expansion market, you wouldn't want to be using reversal strategies, right? You don't want to be using breakout strategies. The same way that during the consolidation part, right, because you're accumulating, you wouldn't want to use the breakout strategies and stuff like that, okay? So you need to know what part of the phase you're in, so then you know how to react and what to expect, okay? So that's sort of what we're bringing to the table here. So we have these models, the Wyckoff models. You can see right here, this is the simple method there, and this is the detailed one, and we've basically simplified all the phases, and we don't need to use any of these acronyms, just to keep it simple. No need to go into too much detail, but you do need to have a certain level of sophistication in order for you to be able to follow the market and follow that template that we were talking about. So we're bridging the Wyckoff model with something that everyone is familiar with, and that's the head and shoulder pattern, okay? So everyone knows the head and shoulder has the left shoulder, the head, the right shoulder, and then the neckline. And then there's like some rules to, if it breaks the neckline, that starts your trade. You're supposed to short here, do this, do that. Again, we're simplifying everything, but then we're adding some characteristics of things to expect during phase one, things to expect during the phase two, and then during the phase three, and then we have an extra one called phase four, which I guess if you think about it here, it would be after the neckline, but again, we don't mention that at all. So this is what it would look like right here. You can see the phase one, the phase two, the phase three, the phase four. Because this is a sell model, you have the accumulation of cells, and again, the rest of the model, which we will talk about later in this video. And then you have the same exact model here, but labeled as a head and shoulder. So you can definitely see that there's a very clear correlation or similarity between the two. Now, what we did, like I said, right, most people know these models, but we want to bridge it with some sort of way to confirm. So that's what we used. Larry Williams, brilliant guy, and from his book, Long-Term Secrets to Short-Term Trading, you guys can feel free to check that out. Right here, we actually created a Tradingview indicator that can follow the structure of the market. And here we have, long-term highs, intermediate highs, short-term lows, and stuff like that, which we will explain what they are later in the video. But that's the key here, okay? We want to bridge the gap between those first two models and then these confirmations of the market, the structure of the market, so we can guide ourselves through those models. So let's get started with the phase one. Okay, so starting here with the phase one, that's the left shoulder, and this is the accumulation phase. Let's talk about some characteristics of this stage, and here is where you'll find the early buyers or sellers This will be the fake out move before the actual high or low is seen. And then another way you want to think about this is that, if you think of the theory of what's going on, is that the large money will be using this to add some of their positions before, potentially entering in full risk. So we can call this, the phase 2 then would be the VFE pricing, right? And then last but not least, they could also be using this to create liquidity for their positions in phase 2, as they will take the other side of the people who get stopped out, right? So that's what we should be thinking about during this stage. We don't want to be taking any positions, because you're either creating the liquidity, or or the smart money is looking to add their positions early, which will then get stop hunted for their full position in order to shake out those last amount of people that could be right about the trade. I mean, how many times we've been stuck in a trade where you get in, the market drops a little bit, exactly how it did here in this picture, only for your stop to be above some high here near the market. You get stopped out, and then you're no longer in the move. The market runs away without you, and you're left sitting there like, what the hell, right? So that's why phase 1, we don't want to take any positions. The better you get at recognizing this, the better you'll be at taking your trades. And the best way I know how to do it is the fact that I just flat out don't take any positions until I see that we're stop hunting a phase 1. I always joke around that if there is no stop punt, then you will be the stop punt, okay? So that's something you guys can keep in mind. Right before you're taking a trade, you always have to ask yourselves, has there been liquidity taken? If the answer is no, then guess what? You will be that liquidity. And that's why before I even taught you guys these models, I've been really hammering in the idea of where the liquidity is at potential highs and lows. Now, that did not mean it was going to reverse at that point, right? It could have just crushed that high or low. But using these models, hopefully we can get to a better scenario where we can start to confirm whether it will stop at those highs and lows or not, okay? So let's go on to phase 2 and move forward with these models. Okay, so now we can start getting to the good part here, since phase 2 is really what we're interested in. Phase 1 is just to identify what we should be stop hunting so we don't get too out of line, and then phase 2 is when things start to get a little bit more interesting. So this is the head of the model, and the characteristics of this stage are known. R1, it's known for stop hunts, and this is to create the anchor of the model, okay? Number 2 is that price should be taking out an important liquidity low. That should say low or high. So it should be an important liquidity level, right? So the one that will be built up from phase 1, okay? So that's why you really, if you look for phase 2, you should have a higher degree of probability to be right. So then you want to look for an intermediate high or low, an ITH or ITL, to be rated, as this could be the future long-term low or long-term high. And that really is the key, okay? So when you're thinking about a phase 1, the key would be to wait for the market to form an intermediate. That's this blue triangle here. You don't want to be trying to pick a phase 1 on just a short-term high or low. Now, could that end up being the high? Yes. And as you start to study these models, you'll see why. We're not going to go into it right now. But the point is that you have a higher degree of probability of it being the right phase 1 when you choose an intermediate high or low, because after that gets rated, then it could turn into a long term. Now, if you have no clue what I'm saying, fear not, because we will be talking about this a little bit later on. So another characteristics here is, in order to have an impulse leg in the market, you need to have a long-term high or low, okay? So that's really why we want to be really focusing in on identifying a phase 1 intermediate, and then rating that intermediate, that phase 1 intermediate high or low, and then looking for that to be our anchor leg in the market. So how does that look like? Well, right here, this is exactly what I'm saying, right? You see, you have your intermediate. So this intermediate here, remember, intermediates are only formed after it has a short-term to the right, a short-term high to the right, and a short-term high to the left. So as the market is moving higher, moving higher, moving higher, you're thinking, oh man, this might be the high. Well, guess what? It can't be the high. Because remember, highs are made on long-term highs, right? So if highs are made on long-term highs, the market goes higher. That's one impulse leg. It retraces. That's only creating a short-term high. Then it goes up one more time. But because it made a higher high, then now we need to be, if this is going to be the high here, you would have needed to have seen what? A lower high be made on a short-term swing. Well, guess what? A short-term swing did get made, but it was a higher high. So you see how the model wasn't completed there, right? The phase one wasn't able to be completed. But then what do we have here? We have a short-term high, then a higher high is made, and then price drops. So when price dropped here, this turned into a short-term high. Now, when that price dropped right here, and then this short-term high got created right here, then this one turned into an intermediate. Now again, we're not buying, or so we're not selling this. We're waiting now for that intermediate swing high to get rated, and that's the important liquidity that I'm talking about. Once that gets rated, now we start to qualify. Could this be the high? Is this going to start my model and turn it into a long-term high? And that's the beauty of this, guys. You see how just by following the structure of the market and the language, and by understanding what I've been telling you, or what I will finish telling you by the end of this video, you can definitely see when you should be either A, taking profit because you bought down here and you're looking for a high, or B, when to start looking for sells. So it really is that good, guys. So let's talk about some more characteristics of this stage, right? So as the model is starting on phase two, you'll want to confirm the raid as a short-term swing. Very important, okay? Then after, you'll want to wait for another short-term swing to form to the right of it, right? Because when it forms to the right of it, then that will make our anchor an intermediate high or low, okay? And the example back here, once this short-term high here was formed, that turned the head, so the rating swing of the phase one, right, of the left shoulder, it turned it into a intermediate. Now I understand that it's square here, but that's just because I took this picture in hindsight, right? You guys will get to see how it develops in just a few seconds here. So we have that, and now here you can take your first trade, and then your stop would just be at the high. So right here, it is important to note that the phase two trade that you might take could be subject to a retracement, and that's because you've yet to see the phase three, which is when the right shoulder is forming, right? And like a right shoulder, there should be a deep retracement into the premium of the head, okay? So your stop loss here would go at the intermediate high or low, since this is the anchor of our model, and we should not expect to see this taken out, or we will have to start the model all over again, okay? So if what you think is going to end up being the long-term high or low ever gets taken, like price goes above it, then the entire model has to start all over again. So that is probably the safest place to put your stop. So I know I'm saying a lot of words here, and you might have to rewind a few times, but once you get this, you're really gonna love the idea. And here's a clarified picture of how it forms real time. Okay, so real time, you'll have some sort of a phase one, right? And then you'll raid that phase one. And when you raid the phase one, it'll initially form a short-term swing, okay? So once that short-term swing is formed, that does not mean enter. You're not entering any positions yet. You're entering a position after a short-term high is formed to the right of that short-term, right? So this is the way it looks at first, and then this is the way you want it to look. Once this happens, you can take your first position, right? And your first position in this case would be at the open of this red candle, and then your stop would go right here. So obviously the market did drop. Everything was fine and dandy there. So that's our phase two, okay? Now let's go ahead and move on to our phase three. Okay, so now we'll move on to the next part of the model, and that's the phase three, which is the right shoulder. And we will talk about the characteristics of this stage. So for this stage to begin, you want to look for after phase two is confirmed, and that is when it's confirmed by a short-term high or low, which will then turn the intermediate, which will then turn that short-term high or low, that's the head, into an intermediate, okay? So once that happens, you want to start, you can either, remember, from phase two, you can either take a trade right then and there, or you can wait for the retracement, right? And that would be a phase three retracement, which is your sell at some sort of a premium or a buy at a discount, okay? So there it is right there. So entry should be done at least 50% of the range or deeper to 78 using the Fibonacci retracement tool. You want to wait for a short-term high or low to get rated or for one to get created at that discount or premium. And this goes back to the idea I said earlier when we started the video. If you're entering a trade without liquidity being rated, even if it's just a retracement within the price leg, then you are the liquidity that might get rated. Okay, guys, very important to understand. So when you're taking a trade here for this, the phase 3, which is the right shoulder, the stop loss can be put at the head, which again should now be an intermediate high or low, and that will just be the safest trade. Once again, the reason you're doing this is because if you're trading the right shoulder and you expect it to be a legitimate head and shoulders, then the head should never get broken, right? That phase 2 should never get broken. Now the stop is not at the current high, because the current swing, what will end up being the right shoulder, right, it has not been confirmed yet. As you can see here, all of our confirmations are made by this indicator that we created on TradingView. So I'm going to show you guys a picture here. You can see that this is the phase 2 head. There is a blue triangle right here. That, remember, the triangle was made the second that this red candle opened, right, because it had a short term to the right of it. So once that happened, I could either, one, take a trade right then and there, that would be my phase 2 trade, or I can wait for my phase 3. It just so happened that it didn't have to go too far of a retracement. You can see that, let's just say I didn't take a trade here for the phase 2 trade, then it drops, it comes straight back, and that's what gives us our phase 3 right shoulder, right? So that's going to create the phase 3. And remember, this kind of intuitively makes sense, because in order for the head to turn up from a short term to an intermediate, a short term has to get created to the right of it. So then by the time the phase 3 is coming back for the retracement, you're going to have a short term high to rate. You see why that's so cool? And then remember, what did I say? The phase 3 doesn't get confirmed until this swing that makes the raid turns into an intermediate. So what do you guys think needs to happen for this right here to get turned into an intermediate? Well, we already have a short term to the left of it, right? So all that I need is a short term to the right of it, and that would then confirm our phase 3, which will then bring us into our phase 4. So again, beautiful stuff when you follow the model. And you can see here, right, it was at least a 50% retracement. It just missed 61, but then it rejected below it, and that was the raid right there. Moving on to phase 4, and really the phase that we should all strive for being in on is the expansion phase. And basically what we look for here is for the phase 3 or the right shoulder to be confirmed. This will happen when the short-term high becomes an intermediate high or low, and then the head becomes a long-term high or low. Again, very important, because that will let us know that our model is basically fully to complete. So here we should be able to see value areas, bull or bear trending, right? So we should be able to use these, as this is the type of trading that we want to be looking for. And breakout strategies should be used during this time, hence the value area high strategies there. And then for the entries, we should look for the discounts from the long-term high or long-term low. So the same as what we were doing for the phase 3, but in this specific case, it should really not go much deeper, if at all, right? You really don't want to see it go deeper than the right shoulder, intermediate high, or low, okay? So we're going, that was confirmed in phase 3, right? So, and don't worry, we're going to take a look at this picture in just a few seconds here, but once you're in your trade, or if you're already in it because of phase 2 or the phase 3 entry, you want to look to target left side liquidity, aka left shoulder targets. So another thing you can do is you want to look for higher time frame liquidities that could start a new model. For example, if I'm short, anytime I raid an intermediate low from the left side of the model, then I want to be very, very careful, because that might start a brand new model counter to my sell, and that will then potentially stop me out. So you can see right here in this picture, on our phase 4, we're going to see, right, so how do we qualify it? Well, in the previous picture that I showed you guys from phase 3, we were looking at this impulse leg here, rated that short-term high, and then I told you guys that during the drop we would form a short-term high to the right of this short term, right? If that happened, which it did here, then this phase 3 would turn into an intermediate instead of a short term high, right? Once that happened, then this right here would become a long-term high. So then that right there would mean that now we're looking for the phase 4, which is the expansion phase. Now that could happen 2 different ways. It'll just straight up fall out of bed, or it could have a big retracement. Again, this is the key. That retracement, you really don't want it to go further than the intermediate leg that turned this phase 2 into a long-term high in this case, right? And that's because, like the quote-unquote, like, damage has already been done. So I would just pull a fib from this swing high to this swing low, and then that would be the key. Now I drew this vertical line here because this short-term swing, it takes 2 candles to form it, right? So at the open of this green one, that's when this turns into a short-term high, and then this turns into an intermediate high, aka the right shoulder, and then this turns into a long-term high. And then here now you can see the same exact thing, but with the fibs. So if I'm taking a position, it's going to be at the premium of the full range, right? And then you can see right here, obviously 50%, but at 50%, you hadn't seen the short-term high yet, right? You were already above this one, so I'm not interested in that. So then this one right here, you go above that, and you get really, really, really close to this intermediate swing, which is basically the 78 of the entire range. So there you have it, guys. That is our fourth and final phase. And this is exactly how you should be thinking about the market. So if you have any questions, anything you want me to clarify, just let me know in our Discord. There's a link in the description below. And who knows, if you guys still need some more clarifications, maybe I can make a separate video on that. So I hope you guys enjoyed this. I hope it helps you. Stay safe, and we'll talk soon. Peace.